Well, welcome. I'm glad you could join us for this discussion of investing after college. Uh, what you'll see is we're going to talk some about investing for the short term and intermediate term, but most of this discussion is going to be about long-term investing, and in particular, investing for retirement. You've probably heard before, but in case you haven't, a person can borrow money for a lot of reasons. They can borrow money to put themselves through college, or to buy a car, or buy a house, or for any number of reasons. But the one thing you can't borrow money for is for your own retirement. You have to have your own retirement funded. And so that's why it's really important to focus on investing for the long term, because the one thing you cannot borrow for is for your retirement. So we're going to focus on long-term investing here. And as I said before, if you have questions, go ahead and send them to Andrea, and we'll take it from there. If you would like access to this presentation, I have a Dropbox that has financial literacy files in it, and so you're welcome to just jot down this abbreviated link, and you'll have access to the presentation. So I'll just give you a second to write that down if you're interested. Okay, so here's where we're going to start. By introduction, we'll start by talking about why we invest, and then understanding the risk and return trade-off when we're talking about investing, particularly in stocks, and then how we invest for the long term through tax-advantaged accounts, investing in both stocks and mutual funds, or stocks or mutual funds, and what's the difference between active and passive management. So all those will be part of our discussion for this evening. For a professional, this discussion usually involves a 7-step process. Now, for you, I'm going to tell you that there are some parts of this process that a professional can do for you if you invest in mutual funds. And so that makes the process quite a bit easier. But there are parts of this process that you really need to do yourself, including the first step, which is defining your objective. The next step, to figuring out what your constraints are that go along with that objective. And then third, what your strategy will be. Once you know your investment strategy, really the allocation decision and security selection decision can be made by investment professionals, but that will still leave you looking in at the performance, or measuring the performance, I would say every quarter, every 3 months, and then evaluating or rebalancing or changing your portfolio as you see fit. First and foremost is your objective. What's the money for? Are you saving money for an emergency, or to buy a car, for a house down payment, for retirement, or for future expenses? The number one thing you have to know is what are you saving for? And along with that come the constraints, and the number one constraint is the one that is the primary driver behind how you're going to invest. So the number one thing is to know what's your time horizon. When do you need the money back? If you need the money back in a few months, you don't want to buy stock with that investment. On the other hand, if you don't need it back for 30 or 40 years, then stocks are the best place to go. Kind of going along with that time horizon question is a liquidity question. Is there a chance you might need the money back sooner? And that really revolves around something called liquidity. Liquidity really means, in this instance, investing in instruments that are easy to sell, and investing through accounts that you are allowed to take money out of. So if you're short-term investing, you probably need more liquidity, and you need the ability to pull money out of the accounts quickly. Whereas if you're investing for retirement, you may be okay putting that into accounts where you really just can't touch it. Other questions would be what tax considerations would be involved. Another is, do you have any personal constraints? Would you want to maybe only buy socially responsible funds or companies that are socially responsible? Are there particular companies you would want to avoid? So you'd want to think about that as well. And then finally, what's your risk tolerance? You don't really want to be buying investments that are going to keep you up at night. So you need to consider that as well. So when I'm thinking about allocation generally, the first place I go to is, again, how long until you need the money. And so I look at it this way: if your investment horizon is less than 5 years, then I highly recommend that none of that investment be invested in stocks, that it instead go into short-term bonds, where you could ladder it to when you need the money, or most likely just put the money in the bank. That way you have easy access to it, and it's 100% guaranteed. At the other end of that horizon spectrum, if we're talking about 15, 30, 45 years, then we're talking about an investment that would primarily go into stocks because they have the strongest growth attributes. You might have some in bonds or real estate, maybe a little bit in a bank investment, but primarily you're looking at stocks with a little bit and maybe bonds and real estate. Any questions about this in particular? Okay, I'm going to keep going then. Next, the tools. So the things we'll be talking about are, first, just for short-term investing, would be FDIC insured CDs or savings accounts, or money market funds. A money market fund is through a brokerage company or an investment advisory fund, but it's also extremely low risk, in many cases no risk, but also very low return, much like investing in a savings account. At the other end of the spectrum, we have stocks, both domestic and international. Same for bonds, domestic and international, real estate investments, and then mutual funds of all of the above. Mutual funds and ETF. ETF stands for Exchange Traded Fund, and we'll talk about the differences in those as we go along. Now, focusing in particular on that long-term investing, if we're talking about retirement, I think a good way to think about this is thinking about having an allowance in retirement, and in particular, a monthly allowance. How much money would you want to have as your allowance once you stop working, and so you're no longer bringing money in? So you're going to have to live on that allowance. Now, for guys your age, I would say look at the bottom end of this chart, 5,000 and 6,000. It's much more likely that you're going to be wanting an allowance of that size when we're talking about really 30 to 40 to 45 years from now. In the next column, you'll notice that I put 360 months, which is, of course, 30 years. I think you should consider having retirement income that lasts 30 years. Many folks your age are going to live to be 100 years old. And so it's, even if you don't retire until, say, you're 70, you could very likely have a 30-year retirement. And so when I calculated these balances, I did it with the idea that, one, you would want them for 30 years. And second, once you're in retirement, the amount that you start with would grow by 2% a year above the inflation rate. So with those in mind, I was able to calculate these amounts that you would need, most likely over $1 million at the start of your retirement in order for it to be able to fund your retirement for that 30-year time period. So, think realistically that even excluding Social Security, you're going to want to have saved, $1 million plus, maybe well over $1 million for your retirement. Now, to get there, it helps to have some tax advantages. And most people investing for retirement make use of these three account types that all have significant tax benefits for investors. The first one is called a 401k plan or a 403b plan if you work for a nonprofit. Now, these come from your employer. So when you're getting out of college and getting that first job, you should be looking for employers who offer 401k and 403b plans. And so the way these plans work is that every time you get a paycheck, a little bit of the money, let's say 5%, is taken out of your pay pre-tax before you pay tax on it and put into that 401k plan or 403b plan. Many employers also will match a portion of whatever you put in. So for example, 100% match would mean that if you put in 5%, your employer puts in 5%. A 50% match would be you put in 5% and your employer puts in 2.5%. So not only would you be looking, for companies that have these plans, but also companies that include matches. Outside of these employer-backed plans, there are IRAs, individual retirement accounts. And the most popular one today is called a Roth IRA. And a Roth IRA would be a terrific way for you to invest right out of college. What's so terrific about it is, right out of college, you're in a pretty low tax bracket. Your earnings are going to increase as you work throughout your career. And so at the beginning of your career, you're kind of at the lowest tax bracket you might ever be for the rest of your life. And while you're in that lower tax bracket, it's better to have an investment where you pay taxes up front instead of paying them later. So the way a Roth IRA works is when you open the account, you open it with just money that you saved and probably paid tax on when you earned it. You have no tax benefit up front. But when you retire and take the money out with all of its accumulated earnings, you don't have to pay any tax on that, which is fantastic. Highly likely that you'll be in a higher tax bracket then, and so you save a lot of money by avoiding all that tax later. The third account is a traditional IRA. Traditional IRAs, when you open them, you get an immediate tax break the year that you open them. And so if you put $5,000 into a traditional IRA, you would lower your taxes in that year by $5,000, the taxable amount would reduce by $5,000. But when you take money out of a traditional IRA in retirement, all the money you take out is taxable income just as if you were earning it that year. So the traditional IRA really is more beneficial for people who are already in a high tax bracket and who are likely to be in a lower tax bracket at retirement than the tax bracket they're currently in. But these are the three accounts to consider. On this next sheet, you see that I've kind of broken down what I was just saying, what the advantages of one versus the other. And so I'm just going to skip over to this right side here and say, when is it the best choice? So the 401k, 403b, these are the ones from your employer. They're typically the best choice when your employer is offering a match. Okay? If your employer is not offering a match, a 401k is still good, but it's not as good as an IRA because a 401k has some hidden fees that an IRA does not have. Okay? So if you have enough money to do both, I'd say do both. But if you're choosing one or the other, the employer match makes the 401k better. Without it, the IRA is better. Again, for you guys being younger, the Roth IRA is typically the better choice because you're not paying any income tax when you take the money out of the account at retirement.
So I had a question.
Yes.
Sorry. So how would you apply for either Roth IRA or traditional IRA? Would it be through a bank or would it be through like a broker?
So it could be through a bank or a broker. I'm going to recommend some fund companies specifically a little further in the presentation. Fund companies that either I'm using or I have used, and they have really good reputation, and they also have low fees. Okay. Okay. I should point out that, again, for young people who are putting money into a Roth IRA, you might be thinking, I think I want this money for retirement, but what if I change my mind, say 5 or 6 years from now, and I decide that I wanted the money instead for the down payment on a house or for something else? Well, Roth IRAs, unlike the 401k or the traditional IRA, have a lot of rules for people to withdraw their money earlier. So I copied a list of that because there are a lot of them. So there's a whole page of rules for Roth IRAs for times when you can withdraw before you turn 59. And I've highlighted one in particular that I think is important, and that is you can withdraw up to $10,000 to pay for a down payment on a house. So even if you open a Roth IRA, let's say right out of college, and 10 years from now you decided, boy, I wish I hadn't done that. I wish I had that money for a down payment for a house. No problem. You can take up to 10,000 out, for that purpose. And as you can see, there are a lot of other good purposes as well for taking money out with no penalty and with no taxes. Okay. When we talk about investing, particularly long-term investing, we talk about risk and return because now we're really talking about stock market investing. And so it's good to understand return and it's good to understand a little bit about risk. And so when we talk about return, all we really mean is the growth rate of your money. How fast is it growing? So the percentage growth rate of your money is the return on your investment. I just did a little math here. You can see, so if you started with $1,000 and it grew to 1,050, the math on that is just the percentage rate growth, the percentage growth rate. In this case, it'd be 5%. And when we talk about risk, now from my world of investment professionals, risk really means the difference between the expected return and the actual return. But for many people, risk is really identified as what's the chance of losing money? What's the probability of a negative return for your investment, or even just not keeping up with inflation? All of us, all of us probably took a statistics class at some time in our lives. So you may remember that if you're looking at a distribution, and so this is a histogram of stock returns, when you're looking at a distribution that's fairly bell-shaped and symmetric, it approximates a normal distribution. And so the US stock market actually approximates a normal distribution, which means if we know the average return and the standard deviation of returns, we have pretty much all we need to know to incorporate the entire distribution. So with that in mind, I want to talk means and standard deviations for a minute. From this chart, you can see that there are different average returns for the different types of investments. Small company stocks, in the long run, have had much higher returns at much greater risk than large company stocks or intermediate bonds or even treasury bills. And so the way to read this would be that small company stocks, on average, over nearly 100 years, let's say 92 years, had an average return of 16.5%, but with a standard deviation of 31.7%. Now that's a really big standard deviation. Small company stocks are highly risky. A way to interpret that would be that if you invested in small company stocks for just 1 year, and I should pause and say, I mean a well-diversified portfolio of small company stocks, not just one or two. I mean like 1,000 companies. So it's still a diversified portfolio, but still highly risky. The probability of losing money as a 1-year investment is over 30%. But as a 10-year investment, the probability of losing money falls to only 5%. And as a 25-year investment, the probability of losing money falls to 0.5%. So as you can see, these make a lot of sense as a long-term investment, and they make no sense as a 1-year investment. If you're investing money to save for a car, you wouldn't put it in small company stocks. Moving down to large company stocks, we can see slightly less return and somewhat less risk as well. Average return over the last 92 years of a little over 12%, standard deviation of almost 20%, again, quite risky as a 1-year investment. Probability of loss, 27%. But on the other hand, as a 25-year investment, probability of loss of only 0.1%. Very low risk, or I shouldn't say low risk, but very high probability of a positive return as a long-term investment. And that's because the growth rate of the returns exceeds the growth rate of the standard deviations. For intermediate bonds, much less return and much less risk. Still tricky as a 1-year investment. If you were going to buy like a 5-year bond, you wouldn't buy a 5-year bond to invest for just 1 year. You might buy it as a 5-year investment. By the time you get down to it, looking at it as a 10-year investment, though, quite low risk and really minute risk of loss over 25 years. And if you wanted no risk, you could just buy 3-month treasury bills and you have no risk. You also have very low returns. So that wouldn't be terribly helpful for investing for the long term, because you really need higher returns than that. So now you're ready to start buying. So you ask yourself, can I buy Google, Amazon, Tesla? What do you think? So here's my rule. My rule would be, don't buy any individual securities. And I would say for your first $500,000, don't buy any individual securities. Buy mutual funds and exchange traded funds. And the reason why is because you get instant diversification and for a very small amount invested. For example, you could, with a $1,000 investment, buy a mutual fund that owns the entire US stock market. So you've got fantastic diversification on a $1,000 investment. Here's an example of why that matters. Yesterday, now the darlings of the stock market are known as the FANG stocks, and they are Facebook, Amazon, Apple, Netflix, and Google. They're referred to as FANG. Netflix stock price dropped 11% yesterday. In one day, dropped 11%. And so that really just goes to show you that, just buying a few individual stocks is highly risky. And it's risk that you could diversify away and really largely eliminate by owning a nice diversified stock portfolio. So I really wouldn't recommend buying individual stocks until you have so much money that you can buy a diversified portfolio with individual stocks. Whereas with mutual funds, you can have a diversified portfolio, with $1,000. Okay, so what are mutual funds? Mutual funds are corporations, and they're corporations that are set up by these financial advisory firms like Vanguard and Fidelity Investments, locally T. Rowe Price. I like all three of those companies, and Charles Schwab is another one that I like, and I would recommend any of those four. The thing about a mutual fund is it has taken a pool of money from its investors, that's us. And so it's going to manage that pool of money in a manner that's consistent with the objective that fund manager has stated. Okay. You might also hear of exchange traded funds, or ETFs. I would suggest think of those as mutual funds, but they have a slight tax advantage. So if your mutual fund company is also offering ETFs, you should consider them as well. Okay. Strategies. When you start looking at mutual funds, you'll see that they have either passive or active strategies. Passive strategy, which you typically see in what's called an index fund, is to simply match a major stock market index. For example, it could be the entire US stock market, or let's see the Standard & Poor's 500, which is the 500 largest stocks trading in the US, or any other index. But the goal of a passively managed fund is typically simply to replicate the returns of that index. One advantage of that strategy is that Typically, those funds don't underperform the index, right? They match the index. They're not doing better, but they're not doing worse either. And secondly, passive management involves a lot less trading. And so the fees associated with a passively managed fund are very, very low. They're nearly zero. Like they're often like 0.01 or 0.02%. Not 1%, but 0.01%. Very low fees to manage a passive investment portfolio. The other type are actively managed, where the goal was typically to beat a predetermined benchmark portfolio, such as a market index. Actively managed portfolios typically have fees of 0.75% to 1%. If they're domestic stock portfolios, maybe a little lower. If they're foreign stock portfolios, typically a little higher. The thing I will tell you is, while the goal is typically to beat a predetermined market index, on average, fund managers do not beat the indexes. And so year after year after year, the watchdogs of fund management performance, show that less than half of portfolio managers are able to beat their indices in most years.
To clarify, by fees, do you mean percentage of your initial investment or percentage of your earnings?
So it's typically a percentage of the assets that you have. So if you put in $1,000, it's going to be based on that $1,000. When the 1,000 grows to 2,000, it's now going to be based on the 2,000. So it's a percentage of your assets. Thanks for asking. Okay, so there are a lot of different types of mutual funds, and I've listed kind of the broader varieties. And I want to focus in terms of just getting started on these two at the top. One is active, one is passive. And the first one is called retirement target date funds. And the second one are total stock market index funds. There are also, hundreds of domestic stock funds, international stock funds, bond funds and international bond funds, real estate funds, and allocation funds. But let's just focus on those two for the day that you walk out of college, get that first job, and need to get started. A retirement target date fund, and here's an example. This one is this is from T. Rowe Price. What the fund managers are doing is they know that by buying a particular target date fund that you're planning on retiring around the year on that target date. So for example, you guys getting out of college next year might be buying a target date fund that's called the Retirement 2060 Fund or 2065 Fund for the year that you plan on retiring or sometime around there. So let's say that you were buying the target date 2060 fund, and this is 2021, you'd be looking here, right? And you'd say, oh, I've got 39 years until this fund thinks I'm at retirement age. And so it's going to invest almost 100% in stocks. So stocks are equity, bonds are fixed income, okay? So the way that works then is the managers know that the people buying the fund aren't going to be retiring for a long time. As those people age, the managers of the fund start to change the allocation of the fund to reduce the risk. So as you get down to 20 years before retirement, they reduce the risk a little, and then more and more and more, so that by the time you're at your retirement date, the fund is more like 55 to 58% stock and the rest in bonds to lower the risks of the fund. And it continues to lower the risk as you get further through your retirement. And so this is all set up for you. The fund managers are going to know, they're going to buy, actually, they're going to buy a little bit of domestic stock funds and international stock funds and bond funds, but they're going to buy them in allocations that make sense based on your target date. So if your target date is 2060, they're going to have mostly domestic stock funds and international stock funds. Whereas if you're beyond your target date because you're already in retirement, those funds would then instead own mostly domestic bond funds and some international bond funds with a bit of stocks as well. Any questions about that? Okay. So I highly recommend the day that you walk out of school, and if you get a job and your company has a 401k plan, that this is the first fund you look for is one that's called a retirement date fund. And that you could put all of your 401k into that fund, or you could put a large percentage of it into that fund. The second fund that I would consider both for 401k plans and for IRAs is an index fund. For example, one that owns the entire US stock market. So by saying you own the entire US stock market, really this is what I mean. And I just pulled this yesterday from Fidelity Investments. Their total market fund owns, the total US stock market, including 25% information technology. So companies like, Google and Microsoft, healthcare, consumer discretionary financials, all the way down. You own a little bit of the entire U.S. economy when you own this fund. The other thing to like about these types of funds, again, is they have extremely low management fees. In fact, Fidelity Investments has one with a zero management fee to attract young investors like you. Zero management fee and zero minimum balance. So this is a great way to get started in an IRA. It also works really well in a 401k plan. So I would highly recommend that right out of college, getting started, that you could really just make these two investments be the only investments you have for retirement. One would be a target date fund for retirement, and then secondly, an index fund. You could have 50-50 of each of these, or maybe 60% retirement fund and 40% index fund. So it'd be a perfect way to get started investing. Now, actually, I'm going to skip over this slide and come back to it. Andrea, you had asked about how to invest in an IRA. And so here's a list of the 20 largest mutual fund companies in the US. And I've highlighted the 4 that I know about and like. And so those are Vanguard, Fidelity Investments, T. Rowe Price, and Charles Schwab. And what I like about them, so I use Fidelity and T. Rowe Price, and I've seen Schwab. One I can tell you is that they have fantastic websites. They're very easy to navigate, so you can do your investing from home. Secondly, their funds have good returns. And third, Vanguard in particular is the lowest fee, has the lowest fee funds in the entire market, because Vanguard itself is is owned mutually by its fund owners. It is not a for-profit corporation. So Vanguard has really low fees, good management, a lot of good index funds in particular. Fidelity and T. Rowe Price have good actively managed funds at reasonable fees. And the other thing is that, I'm going to skip down one more. There's different types of fees that go with mutual funds. And this first one is called a load. Now, the companies that I just mentioned, Vanguard, Fidelity, T. Rowe Price, and Schwab, they don't charge loads. So there's no upfront cost to open your account or to buy the investment. That's all free. They're all called no load, or no front end load, no back end load. And it's important, I think, to not have to pay those loads. The second fee is a management fee, and that one is really unavoidable, but you still, from company to company, they vary significantly. Vanguard has the lowest fees, and I would say Fidelity and T. Rowe Price have very reasonable fees. Some of the companies on that list, I would say the fees aren't so reasonable. And other fees as well, although the larger companies typically don't have these 12B1 fees. Backing up a little bit from here, if you wanted to look at different mutual funds from different fund companies, or even 2 different funds from the same company, some of the things that you would want to compare to make sure that that you like one fund more than the other on day one would be, first, make sure that they have comparable objectives, because the other things I'm going to say don't really make sense if you're comparing 2 funds that have different objectives. But if you have 2 funds that say have long-term objective for retirement, something like that, Things to compare would be their 3-year, 5-year, and 10-year returns. And all this is easily available on their website. What their fees or expenses are, and they're expressed as a percentage of the fund assets. The next thing would be the Morningstar rating. So five stars down to 1 stars. I wouldn't buy any funds that have lower than a 3-star rating. The next thing would be the risk. They all have on their websites in their comparisons what the standard deviation of their returns are, and lower is better. And then they also might have another number that's called a Sharpe ratio, and the Sharpe ratio measures how much the return is per unit of standard deviation, per unit of risk. And so a higher Sharpe ratio signifies a fund that has higher return per unit of risk. Of course, past results are no guarantee for the future, but it certainly is helpful to see that a fund manager has been successful. So the last thing I add is, if it isn't an index fund, because for an index fund, you're just matching the index. But if it's not an index fund, check how long the fund managers have been in place. So if they've only been in place for a year or two, then looking at the 10-year history isn't as helpful, right? Because somebody else was managing that fund. But if they've been in place for a decade or more with that fund, then you can typically count on the types of, the quality of management that is historically, evident in the fund's returns. I think that's about all I have. I do have a little bit more advice just on this last page, and that is, should you at some point decide that you want a professional financial advisor, these are just questions that you would want to ask your financial advisor, starting with, most important is the one at the top, and that is, do they have a fiduciary duty to their clients? If they have a fiduciary duty to their clients, it means every decision they're making is with the client's best interest in mind, regardless of whether they get paid as a result of making that decision. If they're not a fiduciary, possibly they might want to sell you investments where they get paid a fee when you buy the investment. That doesn't sound great to me at all. So I would only suggest that you work with an advisor who's a fiduciary. Let them get paid a management fee like these mutual fund managers, where they get paid when the balance in your account increases, and they get paid for you getting wealthier. All right, so that's the presentation I have. What questions do you have that I can help you advance this further? Ready to start investing? Well, let me ask you guys some questions. Would you be comfortable when you're in a job interview asking the prospective employer if they have a 401k plan? And so along with that, you might want to ask them then, what that plan looks like in terms of which companies you can manage, they're using for their plans. For example, Fidelity runs some of these plans, Vanguard does. The plan we have at school has a variety of fund companies you can go with. So you could certainly ask those questions to not just do they have a plan, but then what's underneath the plan, which companies you're actually investing with. Let's talk about opening an account with one of these fund companies. So let's say your company doesn't have a 401k plan, and you're now thinking that you want to start your retirement investing with an IRA. And let's say that you go on Vanguard's website and you see that, sure enough, very low fees, nice selection of funds, and good returns. The way you would start from there would be two things. One, you could call them on the phone. Frankly, they're very helpful. So even though you're on their website, they'll be very happy to be on the phone with you and explain to you how to open an account. So what you're doing is you're opening an account with them, and then you're funding the account by moving money into the account, typically from your bank. You could either send them a check, or you could, through ACH, wire the money into an account. And it's typically going to go into a cash account, and from that cash account, you're buying the investments that you want into the mutual funds. If you stopped there, you probably would have bought the fund into what's called a taxable account, not into an IRA. So if you're setting up an IRA, there's an additional step, and the person on the phone would help you with this as well, that instead of setting up just a regular taxable account, you'd also have an IRA account to make sure that your fund investment is going into a, typically a Roth IRA rather than into a taxable account. Anybody have any questions? Yes, Eden.
Just wondering. So what are these hidden fees that come with like a regular 401k? Because like I mostly just thought it was like, okay, we'll get taxed afterwards, but like what are these fees specifically that are so scary?
Okay, well, so they're not scary, but if a 401k has fees that an IRA doesn't have. And in particular, when a company sets up a 401k plan, part of what they're doing is they're paying for an advisory service, so that if you as the employee want to talk to a financial advisor, you won't have to pay for it. Okay, but you in fact are paying for it whether you use the advisor or not, because it's being taken out of your fund's return as a fee that you're just not seeing. So in other words, if let's say you open a 401k account through your company, they're using, again, let's say Vanguard, and you buy the Vanguard Total Market Fund, well, that fund has a fee of 0.01%. But the fee you might see is 0.5% instead of 0.01%, because there's an advisor in the middle of this as a middle person as part of the 401k plan, and they're getting that 0.5% fee. So that's why I'd say, if your company doesn't offer the match, the Roth IRA is better because you avoid that fee. Another thing I would say is, when you leave a company, you have a choice to take your 401k with you. You can leave it there, or you can take it with you. Always take it with you. Always take it with you, and don't put it into your new employer's 401k. Put it into what's called a rollover IRA at one of these mutual fund companies, and so then it becomes an IRA and has the lower fees. Because since you're leaving the company, your employer is not going to be matching anymore anyway. So once that's the case, you'd much rather it be in an IRA. What else?
I had a comment. That's really interesting because like like us as like millennials and Gen Z, I don't know anybody else who might be older outside of that, but in general, we're said that we're going to change jobs a lot, which is probably true. I don't like being in the same place for too long. So knowing that I could transfer it over, because I've heard a lot of people say, I lost my 401k when I moved from this job to this job. So that's really a really good thing to throw in there.
Yeah, losing your 401k, taking it with you is really the right thing to do. You don't want to leave it behind, and you don't want to put it into your next employer's 401k either. You want to move it into a rollover IRA. Now, the one rule about that is, once your former employer sends you the money, you have 60 days to move it into a rollover IRA, or else you're going to be taxed on it. So not 60 days from when you leave, but 60 days from when they give you the money, which could be months. Yeah. Okay, what else? Oh, I did skip, did I skip one slide? No, I got them all, never mind. Okay. Any other questions?
So I work at a tax or accounting firm, and I'm doing taxes right now, and I see clients with MSAs and HSAs. Is that different from these ones?
Yeah, I don't know what MSA is, but a HSA is a health savings account. And so similar to a 401k, a health savings account typically is something that your employer sets up with you. It goes along with high deductible health plans. So if you have a high deductible health plan, you typically can set up an HSA account, and you'll have withdrawals out of your pay into your HSA account. Now, like a 401k, the money that comes out pre-tax and goes into the HSA plan. The really terrific thing about HSA plans is that if you then spend the money in your plan on medical expenses, you'll never be taxed on the money that you put into that plan. So it goes into the account before taxes, and as long as you're spending it on, prescriptions or whatever medical costs that you need to spend money on, it won't ever be taxed. So that saves you a little bit of money. I don't know what MSA stands for.
I Googled it. It's medical savings accounts.
Okay, so it's probably same as health savings account, just under a different name. Okay. Other questions? Okay, well, I won't keep you. Thanks for coming. And if you have a question later, you know where to find me. I'm lbuyer@ndm.edu. I'm lbuyer@ndm.edu now and next year and in the future. If you have a question, feel free to ask me. So I'm going to stop recording now and we'll say goodbye.